Welcome to the deep dive. Today, we're tackling a pretty hefty topic, the institutional investment case for Bitcoin.
Yeah, there's a lot out there. We've synthesized sources laying out, 21 core value propositions?
Exactly. And obviously, we can't hit every single one. So our mission here is to give you, the learner, a shortcut. We're grouping these into the, let's say, three big dimensions that institutions really focus on.
Right. We're looking at the framework they use. So first, the technological architecture, how it works and why it's secure.
And the economic side.
The economic paradigm, yeah.
Yeah.
What makes it different as a potential form of money.
Yeah.
And finally, the investment framework itself, the numbers bit.
Okay, let's dive in. Starting with the tech foundation. It always comes back to minimizing trust, right?
Mm-hmm.
And the core idea there is decentralization. Bitcoin just operates without needing a central bank or any single authority figure.
Control is spread out across this huge network of nodes, thousands of them.
Which is vital because it means no single point of failure. That's what enables things like immutability and censorship resistance.
And that decentralization directly feeds into the security model. The network runs on proof of work, or POW.
Right, the mining aspect.
Yeah. And here's something interesting. The sources highlight. It's often misunderstood. People talk about the high energy use.
As a negative.
As a negative, exactly. But the argument here is that this thermodynamic proof, this energy cost, is actually crucial. It's a feature, not a bug.
How so?
Well, it tangibly links the digital asset to the real physical world through energy expenditure. It makes attacking the network incredibly expensive, prohibitively so, both in terms of money and computing power.
Okay, so that's the tech backbone. Robust. How does this translate into economic value? That brings us to scarcity.
Yeah, absolute and verifiable scarcity. This is a big one.
Unlike traditional money or assets where, supply can be changed by committees or governments.
Bitcoin supply is fixed. It's baked into the code. An immutable monetary policy with that hard cap of 21 million coins, period.
So predictable supply.
Totally predictable. And this connects directly to the whole digital gold idea, point number 8 in some frameworks. But the argument is Bitcoin actually improves on gold for the digital age.
Improves how? What are the advantages?
Well, think about portability. You could theoretically hold billions of dollars worth on a tiny hardware wallet. Try doing that with gold bars.
Good point.
Then verifiability. You can check its authenticity instantly using cryptography on the public ledger. No worries about counterfeit gold, right?
Right, eliminates that risk.
And divisibility. Bitcoin can be split down to 100 millionth of a coin, a Satoshi. So it's practical for even tiny payments, unlike, say, shaving off gold dust.
Okay, I get the value prop there. Let's pivot to the investment side, the quant view. The sources really hammer the asymmetric return profile.
Yeah, the
asymmetry.
Yeah.
Explain that. The downside is capped, you lose 100% max. But the upside, potentially unlimited.
Theoretically, yes. If it continues to gain adoption as a monetary asset or store of value, the potential upside isn't really bounded in the same way a stock is. This positive skew is really attractive.
Why specifically for big institutional funds, endowments, pensions?
Because it lets them allocate a very small slice of their portfolio, maybe just 1% or even less sometimes.
Okay.
And that small slice still has the potential for huge outsized returns. Returns that could potentially offset losses elsewhere in a diversified portfolio. The volatility is just seen as the price you pay for that potential upside.
Makes sense. And what's driving that upside potential now? The sources point to the wave of institutional adoption.
Absolutely. That's the key catalyst recently. The big watershed moment, as the papers call it, was the launch of the spot Bitcoin ETFs in the U.S. early 2024.
Right, the exchange-traded funds.
Yeah. That just opened the floodgates. It unlocked enormous pools of regulated capital and massively boosted liquidity in the market.
But wait, doesn't bringing it into the regulated financial system with bank custodians holding the keys kind of undermine the whole censorship resistance argument a bit? Is that a tension?
It's definitely a tension the sources acknowledge.
Right.
There is a centralization risk with large players holding lots of Bitcoin via ETFs.
Okay.
But the argument is that the net benefit, unlocking billions in capital, increasing accessibility, improving liquidity, far outweighs that risk for now.
Okay.
It just brought Bitcoin much more into the mainstream investment conversation.
So wrapping this up, the synthesis seems to be Bitcoin emerges as this convergence of really robust trust-minimized tech
Sound economics, based on that hard-coded scarcity.
and powerful network effects, now supercharged by regulatory clarity and institutional buy-in.
Exactly. And maybe to leave you with a final thought, something a bit more philosophical that some sources touch on.
Over.
Think beyond just the investment case. Consider Bitcoin's potential role in maybe fostering the separation of money and state.
How so?
By offering people a credible, non-sovereign alternative, an exit from traditional financial systems, it could act as a kind of check, a non-violent check on government spending and monetary policy. It potentially introduces market discipline for sovereigns.
A check on fiscal irresponsibility driven by the market itself.
Precisely. It's a big idea, definitely something to mull over as you digest all this data.